Hey everybody, so fraud and error. First of all, let's get some simple definitions out of the way. The difference basically between fraud, which is intentional, and therefore would include things like corruption, stealing assets, deliberately making your financial statement show the incorrect view, and error. Error is obviously unintentional. Really important, unintentional. So that would include things like omitting a disclosure, a mistake in gathering the data from where the accounts are prepared, an incorrect accounting estimate due to an oversight, not that you're doing it on purpose. And then finally, let's just make clear what an irregularity is. An irregularity is again intentional. And it's an intentional misstatement to mislead users. Okay, so if a material error is identified, but it's not corrected, then it actually becomes an irregularity. So if it was an error to begin with, but then is not corrected, it then becomes an irregularity, which is an intentional misstatement to mislead users. Okay, so that's what they are. Now let's have a look at the responsibilities. And obviously we're looking at the responsibilities of management and the responsibilities of auditors. Let's have a look at management first. Management, they've got to create safeguards. Okay, they've got to create safeguards to avoid fraud and error, and they do that with internal controls. So create safeguards to avoid fraud and error by using internal controls. Okay, and they're also, internal audit obviously is responsible for monitoring and implementing these internal controls. So, management, they must try and create safeguards that will prevent fraud and error in the first place. Auditor responsibility, again, the auditor is responsible for detecting material misstatements due to fraud and error. Okay, so material misstatements due to fraud and error. And therefore, what the auditor do, he must consider the risk of this at the planning stage. He must think how open these accounts are to fraud and error at the planning stage, and obviously while performing the audit as well. And then, if the fraud is discovered, then they have more duties. If they do uncover some fraud, then what are their duties then? Well, then they've got to firstly report it to the audit committee. So report it to the audit committee. Secondly, report to the management, high level, unless of course they're involved in it. Okay, so record it to management at high level if they're not involved in it. And or put or really here, or the shareholders if it's management fraud. Okay, so that's basically the responsibilities of the management and the auditors. Okay, moving on to how we're going to approach this in the audit. We've already said there'll be discussion at the planning stage. So discuss the risk of material misstatement due to fraud and error at the planning stage. Okay, further procedures. I'm going to give myself a little bit more room, I think. So further procedures. Let's do it around here. That the auditors can do while doing the audit. First of all, ask management what their assessment of risk is. Their assessment of risk of material misstatement due to fraud and error. Ask them about their processes, about their internal controls that are used to detect fraud and error. Ask them how they communicate this to the staff. And finally, ask them, has any fraud occurred? Let's get a management representation to say, no, nothing has occurred. Okay, so that's pretty much it. So we looked at responsibilities, definitions, and then briefly the audit approach, the discussions at the planning stage, and what we do during the audit. What we're going to have a look at next, though, is how do we go about investigating misstatements?